Welcome to TradeTheMBI.com. This is John. This report is for the 8th of October. Well, new signs that geopolitics can certainly impact the market. That was very clear the other day. We saw definitely an increase in the fear factor relative to what's taking place with Russia. Obviously, the oil installations being bombed in Crimea. You had the potential of the Israeli attack and whether or not it will be targeting Iranian oil facilities. We don't know yet, and that uncertainty has certainly upended the market's hyper enthusiasm towards the wonderful economic data that continues to pour through, and the decline in interest rates, along with that wonderful economy, which we all know is suspect. And of course, I'm being facetious, but at the end of the day, you end up with a situation where risk off is certainly more apropos. And for us, it's easy here below the ABM yellow. And let's just put that number up there so that you can see it, the 57.92 range. Definitely want to be on the shorter side of things. It was easy to see relative to intraday that things were imploding quite quickly, and we saw it the pre-market even before when I was doing the video yesterday. It was clear that there's concern because things can escalate quite quickly out of control. You have on the 12th of October coming up this conference about Ukraine and whether or not they're going to be allowed to use missiles deeper inside of Russia. That certainly places unknowns that are catastrophic and completely sidelined, and you don't hear much about it on the news, but it definitely is a serious escalation of the conflict because it can broaden rather rapidly and not in a positive way. We can see the effects of it from the oil trade. NASDAQ here, you can see right up against a critical 910 number here, which is the previous algo level. A dip below that definitely is a much more sustained short. It's just that simple. We can also take a look at that. We mocked this one for quite some time, the out of control nature of which bond traders have been epically wrong for an entire year, which is not customary. And the reality is they're looking at data that has been so skewed and so manipulated, they can't even get a bearing. And the bond market has traditionally been its reliable factor for knowing the direction of things, but they've been completely wrong. We've been talking about it for, well, incessantly for months, and it may seem redundant and a bit excessive that I discuss it, but it's an important reality because it dictates where money flows. Now you have yields continuing to rise as treasuries here coming back down, and that's beginning to normalize that relationship somewhat, which could be a factor drawing money more towards the safety and reliability. And of course, obviously, people wanting to park money has been moving there. We haven't seen as much of it moving into crypto or gold as in the past. But this is the alarming nature of it. The oil rise has been sudden, sharp, should only increase given the fact that we're seeing more and more risk associated with world politics. And I think that's just going to continue in the near term, at least, until there's some kind of clarity as to what will happen and or will the extent of the fear be greater than the actual result. That has been the case overall, but there is that tipping point where it could shift, and it's just being aware of it is, some people say, oh, but you do the fear. Well, it's relative in the sense that you need to be aware of the consequences. It doesn't mean that you react to it until you have signaling that indicates it. So we just continue to follow it. We're going to see the movement. Obviously, you can already see the potential for white MBI spike here on oil, meaning that it may have pushed a little further than the expectation. But you also have the hurricanes that is about to hit. These are going to have significant economic impact. Now, from a market standpoint, they're viewing it as, well, the impact of it will take place after the election, and therefore it's irrelevant at this particular stage. And that may very well be true. They're going to do everything they can to make things seem as rosy as they can prior to November. So you have that reality built into the equation. From a euro standpoint, of course, it's relevant just from a broader global trade situation, but of course, it's going to suffer relative to oil and what it does growth is just not a factor in the EU zone generally, and it's been muted for quite some time. So that's just a trade to pair risk within the trade element globally, and they haven't done a very successful job of it, but it's arbitrarily inflated the euro for no value other than to help international companies in America from an exchange standpoint. And then from a gold standpoint, it's still relatively muted. Now, they can do that for some period of time, as they did for years, using futures and that. But the physical demand on gold right now from central banks around the world has been extraordinary. And the next pop of gold is assured. It's not even really a debatable question. You can only keep it depressed for so long, given what we're seeing from the realities of devaluation for fiat currencies and the deficit spending. The economics are clear on this. There's just no way around it. You can see from Bitcoin, and that has a slight move, fading back a little bit on it at this particular stage. Again, these will be short-lived corrections, and they become opportunities to get in at reasonable levels. ETH suffering significantly more. And this is just a question at this particular stage. Obviously, being in the market has been the greatest yield, but when that shifts, well, that starts to move other asset classes. And I would think that crypto, definitely gold, certainly is in that category. Though the gold situation has broader implications from a dollar standpoint. So they try to keep as much as they can tight handle on that one, but it's a little bit tougher when it comes to the crypto side of things. From 50K, you can see we ended up with the NBI white spike starting yesterday, and that moved into the beginning of the start of pre-market action. And once that magenta started tipping below, the cascade lower was immediate and significant, right to the 50%, as we would expect. Fought back a little bit from there, but then the NBI white regained itself just before the 50% marker. So the expectation would be at that point a break of the 50 would lead to the zero. Haven't reached the zero, so that's an interesting one because you would expect to move all the way to the zero. So there could be some hidden strength within that. And this is something I've talked about. When you don't get that move all the way back to the zero, and that you have a pretty strong build of buy pressure. And so that can create a violent upswing. So it's relatively important to keep an eye out on that one, and definitely above the 23%. You have to be looking more towards the long side, particularly if magenta is above gold at that particular stage. Shakeout in that completely weak from 50K, and you certainly don't have any help from short-term buyers at this particular stage. They've pretty much done everything they can just to keep it where it is. So there's those elements of risk, and of course, paint bars identifying it rather effectively. When we look at it from an intraday standpoint, you can see by mid-morning when things started to appear to be much more negative, the selling began and it became significant. It's all that call buying that was done in between. This is the secondary factor of it. You're wiping out that premium and you're shifting back into puts. And then when there are too many puts, you're going to see the rise, despite what relative news may be. Some of this is completely driven by, where derivatives or options are moving, and so you just see that trade play against itself, trying to take out short hands, weak players, looking for any little bit of scrap that they can take from the broader situation. Because from an overall economic standpoint, you're not seeing any terrific kind of growth or development from a economic standpoint. So the reality is that all we've done is eased off what might otherwise have been a further contraction into what was already marginally recessionary, at least regional development. With the hurricane damage in the southwest there, or southeast, you're definitely going to see some significant economic impact. But again, won't be till after the election, so don't have to worry about it at this particular stage, is what they would tell you. But I think that it's just one of those things you want to be aware of and continue to follow the readings. We're going to see where the money is shifting long before others do. So just take advantage of it that way. As always, though, anything relevant, put on the Skype chat. Have a good one. Trade well.